Be it price action, MACD, Ichimoku or depth of market, it all works. As long as you know how to use them, then you're all good. In this video, we'll take a look at one of day traders' favorite indicators, the MACD. Some say that it's highly unreliable. Let's see how it performs when Algo does all the heavy lifting. What is MACD? First of all, let's try and understand how the MACD is put together. MACD stands for Moving Average Convergence Divergence. There are four parts to the MACD. 1. The MACD line. 2. The signal line. 3. The histogram. And 4. The zero line. The default settings of the MACD are 12, 26, and 9, where the 12 represents a moving average of the previous 12 bars. The 26 represents a moving average of the previous 26 bars. The 9 represents moving average of the difference between the two moving averages. Okay, let's try and unpack this. MACD is moving average convergence divergence. In this chart, the MACD is the blue line. It is the difference between a 12-period EMA and a 26-period EMA. It is considered the faster of these two lines. The second line on the MACD is the signal line. It's red in this case. The signal line is a moving average of the MACD line. It is slower than MACD. This means that we are taking the average of 9 periods of a faster MACD line and plotting it as our slower EMA, which gives us the signal line. The purpose of the signal line is to smooth the MACD line. You'll tend to find that the slower a moving average is, the smoother it is. But of course, this makes it a lagging indicator. The default settings for a MACD are 12, 26, and 9. And the third part of the MACD is the histogram, which are these blue bars. The histogram will cross the zero line when the price is bullish, and it will be below the zero line when it's bearish. The histogram simply plots the difference between the MACD line and the signal line. It is just a graphical representation of the difference between the two lines. Sometimes the histogram will give an early sign that a crossover is about to happen. If you look at our chart, you can see that as the two moving averages, that's the MACD line and the signal line, separate, the histogram gets bigger. This is called the MACD divergence. Because the faster moving average MACD line is diverging or moving away from the slower moving average, which is the signal line. As the moving averages get closer to each other, the histogram gets smaller. This is called convergence, because the faster moving average, the MACD line, is converging or getting smaller to the slower moving average, which is the signal line. Okay, that's that about the basics of MACD. For this strategy, I am not going to change any of the settings. I'm going to use the default settings. And I'm going to use a classical approach to how to use the MACD. I went on the internet and plucked a simple strategy, and let's see how it pans out. In front of you is the chart of NQ. 60-minute time frame, with the MACD with its default settings at the bottom. And on the chart, you will see vertical lines. These are signals which have been generated by the algo that's running behind this. From the chart, imagine if you went long or short at the crossovers. You'd have gained quite a fair bit of profit. It looks good, doesn't it? Okay, let's see what the equity curves looks like. Okay, this is the equity curve achieved on a 60-minute chart of the NQ. It's not exactly negative, but the drawdowns are quite frightful. Okay, in terms of entry efficiency, it's really all over the place. The same with the exit. And you can tell that it's really all over the place here. So the idea is to see how we can actually optimize this strategy. This is an equity curve of the NQ on the daily time frame over a period of 365 days. As you can see, it's not exactly what you'd want to see. And if we take a look at the entry efficiency, it's not exactly that good, and the exit equally bad, and total efficiency of the whole crossover strategy on the daily time frame is obviously unreliable. So let's see what we can do to optimize the MACD so that we get a more promising equity curve. We use the default settings of the MACD indicator. We put this on a daily time frame. Entry and exit is when the MACD crosses the signal line. To avoid false entries, the trading signal is delayed by 3 days. The position is opened at the closing price of the 3rd day after the cross, if no crossing has appeared on day 2 and 3. Close the position when profit is met as follows: take profit 1, 100 ticks, take profit 2, 200 ticks, and the 3rd position, leave it as a runner to be closed by a signal in the opposite direction or a trailing stop. Use the parabolic SAR trailing stop at default settings. Okay, so these are the equity curves produced for the daily and the 60-minute time frame. Let me know what you think in the comments below. And if you have any suggestions of any other MACD strategies you would like me to try, please put them in the comments below. By presenting you with this strategy, I'm not saying that this is the only strategy that you can use MACD on. In the next video, we'll look at day trading strategies using MACD. We might need to incorporate other indicators to make it work, but let's see how it goes. If anyone has any suggestions to use just a purely MACD on an intraday basis, give me a shout in the comments below. Please bear in mind that a successful trading strategy is a function of market movements and money management. Bye for now.